Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Today we're going to take a look at a specific mutual fund. It's called the Fidelity Contrafund. It's a fund I've received a lot of requests to review, and it gives us actually a great opportunity to really dig in and understand the difference between actively managed funds and index funds, also the difference between growth and value. If you're new to the channel, I don't normally wear a cap, and I usually dress up for these videos, but we're snowed in, I'm cold, so this is what you get. But this channel is all about, financial freedom, particularly for folks, like me, a little older than average, whatever. But if you're young, you can watch this show too, but it's really aimed at retirement, financial freedom, doing smart things with our money, that kind of stuff. So if that's for you, feel free to subscribe. Also, I send out a newsletter every Sunday. You can get a link to that newsletter below the video. It's totally free. All right, with that, let's dive right into the Fidelity Contrafund, a fascinating fund. Here it is on the Fidelity website. And when I'm analyzing, particularly an actively managed fund, but any fund, I kind of go through some criteria and walk through them. And the very first thing I look at is the cost. What is the expense ratio of the fund? There are a lot of different ways to get that information, but certainly going to the fund's website like we have here is one way. And we can see here the expense ratio is 86 basis points. That's 0.86 of 1%. 100 basis points would be 1%. And the reason we say something like 86 basis points or 86 bips sometimes is because that's just a lot easier than 0.86% or whatever. And you can see there's gross and net. So sometimes, and they're the same here. Sometimes they're different. Sometimes funds have sort of like, you can call them discounts, where the net expense ratio is actually lower than the gross, but that could change over time and go back to the gross amount. Something just to be aware of if you come across that. Here they're the same. So that tells us this is an actively managed fund. As actively managed funds go, this cost is, I would say reasonable for actively managed funds. We're going to look at a comparable index fund that's a lot cheaper. If you're new to understanding expense ratios, you should understand that if you were to pay 86 basis points across all of your investments, that was the fee across your entire portfolio, over decades of investing, it would cost you thousands, tens of thousands, very, very possible hundreds of thousands of dollars. It doesn't seem like much, right? I mean, we earn, 1 or 2% cash back on a credit card. So how bad can 86 basis points be? The problem is the loss of that compounding over time becomes significant. And so we shouldn't view 86 basis points as a small amount. It's a very expensive way to invest. Now, the question with actively managed funds, though, is it worth it? Can we do better than an index fund after factoring in those expenses? And that's something we're going to take a look at. So we know this is an actively managed fund just from the expense ratio, and we can actually come down, and this really gets us to the second thing we want to figure out is what in the world does this invest in? In some cases, the name gives us a hint, right? Like a Fidelity S&P 500 index fund. But this isn't very descriptive. Is it stocks? Is it bonds? US? International, large companies, small companies? Well, we can come down and at least get some overview here where they describe the strategy. They basically invest in companies that Fidelity believes is, the prices are not fully recognized by the public. But here they invest in either growth stocks or value stocks or both, normally investing primarily in common stocks. So that's kind of helpful, but still doesn't give us the complete picture. And so, one of the things I like to do is just use Morningstar. So we're going to come over to Morningstar, and I've already put the fund in. Just put the ticker symbol in the search box and it'll pull it up. And then I've gone to the portfolio tab here, and we can see, first of all, it's predominantly US equities, not 100%. It's got 6% in foreign companies, but it's predominantly US. And while the description over here said that they can invest in either growth or value, we can see from this what Morningstar calls a style box is that it's heavily weighted towards large companies. This is the fund is represented by the blue dot. Large companies are in this row, medium-sized companies here, small companies here, and we can see the blue dot's actually above the large company row. So it really invests in pretty large companies, and it's in the growth column. Value would be over here, and a blend of the two would be in the middle. So an S&P 500 or US total stock market, you'd see the blue dot somewhere around here, somewhere in the blend. But for this fund, it's significantly tilted towards growth. And that gives us an opportunity to understand the difference between growth and value. And so to show you that, I want to go over to a different fund for a moment. It's the Vanguard Value Index Fund, and I'm going to move my screen around a bit. And we're going to compare Vanguard Growth versus Vanguard Value. And I've gone to the portfolio tabs of each. You can see the ticker symbols for these funds are here. And we can see that these two funds, almost predominantly all US stocks, pretty much the same. And if we scroll down to the style box, this is the first obvious difference. The value fund, well, the blue dots in the value column, pretty straightforward. And the growth, for the growth fund, the blue dots, very similar to the Fidelity Contrafund. It's very large, it's above the large row, but for our purposes, it's in that growth column, right? And we can actually look at the weights where they see, well, they distribute it using numbers, and we can see, again, it's heavily favored to growth. There's some medium-sized companies, no small. Over here, if we can get it to work, let me reload it and see if we can get it to come up. Maybe. Oh, here we go. There it is. So this, again, no small. It's got more medium-sized companies, a lot of the large, and of course it's tilted towards value. So that makes sense. And we can see other differences though. For example, again, the growth is this one on the left. We can come over here to value measures and we can see a big difference. So the PE for growth stocks for this fund, 33, pretty high. Value, obviously, much lower, below 15. And if we go down each of these valuation metrics, the growth is going to be more expensive relative to earnings, relative to its net worth, relative to sales. Again, pretty significant differences as we compare the numbers. And I think another sort of final way to see the difference, and this might be the most helpful, is if we actually look at what they own. And so we just need to look at the top 10 holdings of each fund and we'll get a pretty clear picture. You can see for the growth fund on the left here, except for Home Depot, they're all tech companies: Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Facebook, now called Meta. Over here on the value fund, though, no tech companies really, right? I mean, it's things like banks, Berkshire, health companies, Johnson & Johnson, there's ExxonMobil, pharmacy, drug companies like Abbott and Pfizer. So very, very different types of investing. And I would stress this, that I don't think that growth or value is better or worse. They're very different. Over periods of time, growth will outperform value. That's happened over the last decade or so. I would say over probably longer periods of time, in my experience, value has actually outperformed growth. What the future holds, who knows, right? Which is one of the reasons for a core portfolio, we want a little bit of both, which is why a total stock market fund or an S&P 500 fund are great options for sort of the core of your portfolio. They have both value companies and growth companies. All right, so that gives us a sense of the difference between value and growth. And with that, we can now come back to the Fidelity Contrafund and say, okay, it's a growth company, it's a growth fund. And in fact, if we look at its holdings, yep, it's mainly tech. There is some Berkshire, so it's not a 100% growth, but we've got things like Salesforce, Alphabet, which is Google, Apple, Microsoft, Amazon, Facebook. So very much focused on growth. Now, if you recall, when we were looking at the Fidelity website, it said it can invest in either growth or value. Now, right now, we know from Morningstar it's tilted heavily towards value. One of the things that Morningstar will do, though, is show you at least some history. And it's this tab right here that says historical. If we click that, it shows us, at least for the past 5 years, how Morningstar categorized this fund. And you can see for at least the last 5 years, going back to 2017, it's been growth. So while in theory, it can invest in value stocks, and we saw that it does invest in a company like Berkshire, which would probably be on the value side, it has predominantly been a growth company. All right, so our growth fund. So now we know what it costs. We know that it's actively managed. We know that it's a large growth fund, at least it is now and has been for quite some time. The next thing I like to look at are distributions. What income does this fund distribute to shareholders every year? And I'll show you why that's important. We can see it here on Fidelity. And it's got dividends. We know that, and that's pretty normal for a stock fund. And so it pays out dividends, fine. But look at this. It also pays out capital gains. That's true even if you don't sell any shares. In fact, in December, just a month ago, it paid out over $1.60 per share. That's almost 10%, not quite, of its per share price. And that was after, you see here, distributing 40 cents a share in February. So for the whole year 2021, those that owned this fund received more than 10% of the fund's value in capital gains distributions. We can see that, by the way, on Morningstar as well. We just come over to Performance, and then we click Distributions here, and there are the same distributions we were just looking at. There was the December distribution, there was the February distribution, and here we can see a graph of the total for 2021. The key point here is that this would not be, even if we want to use this fund in our portfolio, not really ideal for a taxable account. You're going to be getting hit with capital gains tax every year, even if you don't sell any shares. Now, again, not a problem if it's in a retirement account where you're not paying taxes year to year, but you'd want to be very careful about owning this fund in a taxable account. So once I've got all of that in place, my next question is, why not just use an index fund, right? So the thing I try to ask myself is, what's one of the most comparable index funds that cover the same, in this case, large growth US companies? And then I want to compare the two. So let me show you how I do that. We were already looking a minute ago at this fund. This is Vanguard's growth stock fund. Now this is a mutual fund. They also have a ETF version of this, but we can use this. This is fine. And I want to compare it to the Fidelity Contrafund, which is, let's see, is this one right here. And I want to go to the portfolio and see what the differences are. Now, these are not identical. As we've noted, the Contrafund has about 6% in foreign companies. So there is some difference. The Vanguard fund has just under 1%. But in terms of growth and size of companies, boy, they're almost identical. You can see the Vanguard fund is right there, and the Contrafund is right here. Now, we will see some differences in valuation metrics. You can see the valuation metrics for the Fidelity Fund are a little lower. 26 versus 33, 4.5 versus 8.5. Actually, I would say some somewhat significant differences. And so, in my view, getting a growth fund with lower valuation metrics actually would be a positive thing. So I'd have to give credit to Fidelity Contrafund here. The question is going to be, does it matter? We'll look at that in a minute. The other thing we can look at again is we can compare their top 10 holdings. And here there are some differences, but frankly more similarities. Certainly the percentages held for each company are different. And the Fidelity Fund has companies like United Health Group and Berkshire in their top 10, both I think probably value companies. But beyond that, very, very similar companies. And so I think, while it's not a perfect match, I think this Vanguard fund could be used as a way to compare performance of these two funds, right? And so how do we do that? Well, as longtime viewers know, I like to use a tool called Portfolio Visualizer. So here it is. It's just portfoliovisualizer.com. And what I've done, this is the home page. I've gone to the backtest portfolio. And all I need to do is put the tickers in. So the ticker for the Fidelity Contrafund, FCNTX, we can put it in here. And it comes up, and we can give this 100%. And then for the Vanguard Fund, VIGAX, there it is. So we're going to compare these two funds. Now, notice what I'm not doing. I'm not comparing this Contra fund to an S&P 500 or a total stock market fund? Why not? Remember, those two funds are sort of core total, either total US market or total large cap, if you will, US market. They can contain both growth and value companies. So comparing that to just a pure growth fund or predominantly growth fund, or for that matter, predominantly value fund, would be like comparing apples and oranges. We want to compare something to the Fidelity Contrafund that has an investment style at least somewhat similar. And that's why we're using the Vanguard Growth Fund as a comparison. I suppose we can put in here, we'll put in SPY, that's a Vanguard 500 fund. We can put that in here just to kind of see the differences. Whoops, not 500, 100, there we go. All right, so we'll analyze these three funds. And we can see, first of all, we always, when you use Portfolio Visualizer, you want to know what the date is. In theory, it goes back to 1985, but in this case, it's limited to January 01 because that's how far back the Vanguard Growth Index Admiral Fund goes back. But that's 20 years, plenty of data. And if we look at the three of them, we can see that Fidelity Contrafund has significantly outperformed the other two. Now, you'll notice the S&P 500 has significantly lagged. Why is that? Well, it's because growth has significantly outperformed value in recent years. Will that remain the same forever? No, it won't. It will go back and forth over various periods of time, which we can never possibly predict. But we will certainly have periods of time where value outperforms growth, and when that happens, the S&P 500 will outperform both of these funds. But I show you this so you understand there are certainly periods of time where either a growth fund, in this example, or a value fund will significantly outperform the S&P 500. I'm going to go ahead and remove the S&P 500 just so we can focus on these two growth funds. And we just have the two of them. We can see that Fidelity has significantly outperformed Vanguard Growth. And we can look at it year by year. So again, the Fidelity Fund is blue. And you can see that for many years, they're very similar. And maybe even Vanguard's Growth Fund, look, recently has actually outperformed. And what I like to look at in this chart is, are there any outliers? Are there any years where a fund really just seemed to outperform the other? And if you look at it, we go back to 2002, 3, and 4, and even 5. That's when Fidelity really seemed to outperform. Certainly that's true in 02, 04, and 05. We can remember some of these years were pretty bad years. Certainly 01 and 02 were pretty tough years. And the reason I like to do that is, what if we started in 08 rather than going back to 2001? What would things look like? Well, now, when we look at them, Vanguard Growth has significantly outperformed the Contrafund, and that's over a fairly significant period of time. We're talking about 13 years. It's outperformed. So what that tells us is, if we're going to look at a longer time period, and we'll put it back to 85, it'll only go back to 2001. What we want to recognize is simply looking at the end result is not a good way to compare funds. We need to look at the time period selected, and we need to ask ourselves, if we've selected different time period, even still a relatively long one, can we get different outcomes? And the answer, as we just saw, is absolutely. We just shave off a few of these good years for Fidelity, and over the last 14 years, well, Vanguard Growth wins out. And that's a really important point to make when it comes to actively managed funds. Over periods of time, an actively managed fund can not only beat an index, can crush it. We saw that with ARK in 2020, absolutely crushed the indexes, but then in 2021, significantly underperformed. And that's the challenging part when it comes to an actively managed fund. It can be very difficult to stay in the fund during good times and bad. With an index fund like the Vanguard Growth Fund, what we know when it's underperforming is that's just how the index is working. That's just how the index is performing. It's not that management of the fund have sort of lost their way and made some really bad decisions. It's just that sometimes An index will do better and sometimes it won't. With an actively managed fund, we have to start asking, has management lost their way? Was there a change in management? Have they pursued an investment style that's just not working anymore? Will it turn itself around and come back? Well, those are hard questions to answer, really probably impossible to predict the future. And that's one of the reasons I prefer index funds. I don't ever have to worry that management has lost its way, made big mistakes, is going to make more mistakes in the future. But again, you have to recognize, like we saw in the early part of the 2000s, where Fidelity Contrafund actually outperformed, at least in this case, one comparable index fund. That can happen from time to time. But to outperform a comparable index for long periods of time consistently, and as an investor to have confidence that it will continue to do so over my time horizon, over my investing time horizon, a very difficult thing, which is why I favor significantly index funds over actively managed funds. So where do I come out with Fidelity Contrafund? Overall, I think it's a reasonably good fund. I would personally prefer a growth index fund like Vanguard, certainly not the only option, but like Vanguard, because I have confidence both that management's not going to mess up, and two, I'm saving a lot of money. One thing I didn't point out, which we should do quickly, is that Vanguard's fund is much less expensive. Instead of 86 basis points, it's just 5 basis points. So remember, in addition to the tax issues, if it's held in a taxable account, Fidelity Contrafund has to outperform this fund by about 81 basis points just to break even. That's not even to outperform this fund. So having said all of that, I would much prefer a growth index fund if that was the kind of fund I wanted to invest in. Fidelity Contrafund, I still think is a decent fund, but I don't have confidence that it will outperform a comparable index fund over the next 10, 20, 30 years. If I'm going to have a large cap growth fund, it's going to be a relatively small part of my portfolio. Again, I like to have most of the portfolio in a core holding, like a total stock market fund. If I were going to put money in a large growth fund like Fidelity Contrafund or the Vanguard fund, it wouldn't, for me, be more than about 10%. And if I were going to tilt my portfolio, I'd personally probably tilt it towards small cap value, not large cap growth. The final thing that I'll mention about the Fidelity Contrafund, and this would be true for the Vanguard Growth Index Fund as well. Growth has outperformed value for quite some time now, a number of years, which tells me there's a good chance that's going to change. These things don't last forever, and we've already seen some shift from growth to value over the past weeks and months. I'm certainly not here to predict the future, and it may be that growth continues to outperform value for a while, but I do believe eventually it's going to change. And so investing and moving a lot of money towards growth right now, particularly given valuations in the stock market, I think is probably not the best approach. So there you go. That's my take on the Fidelity Contrafund. It's an explanation of the difference between value and growth, and generally why I prefer index funds over actively managed funds. If you have any questions, leave them in the comments below. I'd be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.